McDonald's primary revenue stream is not derived from food sales, but from rent and royalties paid by its franchisees. The corporation owns the land and buildings for approximately 85% of its global locations. This structure, established by former Chief Financial Officer Harry Sonneborn, means franchisees pay a fixed base rent plus a percentage of gross sales, typically ranging from 10 to 15%. This percentage rent model ensures McDonald's revenue grows directly with a franchisee's operational success, creating a powerful, low-volatility income stream, distinct from the volatile, low-margin food service industry. This mechanism fundamentally redefines the company as a real estate investment trust operating under a retail facade. Ray Kroc initially focused on franchising the operational system, but Sonneborn recognized the superior leverage of land ownership. Sonneborn structured the company to act as the landlord, legally separating the operational franchise agreement from the property lease. This dual contract system mandates that the franchisee must lease the property from McDonald's Corporation or its subsidiaries. If the franchisee fails to meet operational standards, McDonald's can terminate the franchise agreement. Crucially, the corporation retains the underlying appreciating real estate asset, minimizing financial risk associated with operator failure and ensuring asset control. Site selection is driven by sophisticated geospatial analytics and demographic modeling, moving far beyond simple traffic counts. McDonald's utilizes proprietary algorithms analyzing population density, income levels, competitor proximity, and future infrastructure development plans, including planned road expansions and zoning changes. This data-intensive approach minimizes risk, ensuring that acquired land appreciates rapidly and maximizes potential sales volume. The corporation often engages in strategic land banking, purchasing parcels years in advance of development, capitalizing on pre-zoning value increases, and maximizing the return on equity invested in property.
The standard lease term is 20 years, mirroring the initial franchise term. Franchisees operate under a triple net lease structure, meaning they are responsible for all operating costs associated with the property. These costs include property taxes, building insurance, and all maintenance and repair expenses. This structure shifts the financial burden of property upkeep entirely onto the operator, while McDonald's retains ownership and asset appreciation. The rent calculation involves a base rate, designed to cover the corporation's debt service and initial investment, plus the critical percentage rent component, guaranteeing positive cash flow margin on the real estate from the commencement date. The real estate model provides immense financial leverage for corporate expansion. Franchisees are typically required to fund the initial building construction and equipment costs, often securing loans against their own assets. This effectively uses external capital to develop and improve McDonald's owned properties. The corporation uses the predictable, high-margin rental income stream as collateral to secure favorable, low-interest debt for further land acquisition. This self-funding mechanism allows for aggressive global expansion without significant dilution of corporate equity, creating a powerful financial flywheel effect where rental income fuels property acquisition. Modern point-of-sale systems and digital ordering platforms are integrated directly into the corporate financial reporting structure. This applied technology provides McDonald's with real-time, auditable data on gross sales, which is the precise basis for calculating the percentage rent component. Automated data transmission ensures transparency and immediate verification of franchisee revenue, minimizing disputes and maximizing collection efficiency. Furthermore, centralized predictive maintenance scheduling, informed by sensor data, optimizes the lifespan of corporate-owned assets, reducing long-term capital expenditure requirements for the landlord.
The dual relationship, franchisor and landlord, grants McDonald's unparalleled control over its brand ecosystem and physical assets. The lease agreement dictates specific architectural standards, required maintenance schedules, and mandated capital improvements, ensuring global brand consistency. Failure to adhere to these property standards constitutes a breach of the lease, providing a separate, powerful legal avenue for corporate intervention beyond the standard franchise operations agreement. This legal structure enforces rapid adoption of corporate initiatives, such as mandated technology upgrades or store redesigns, protecting the long-term value of the underlying real estate asset. McDonald's owns one of the largest and most valuable commercial real estate portfolios globally, encompassing over 38,000 locations across more than 100 countries. The valuation of this portfolio is based not solely on market comparables, but primarily on the capitalization of the guaranteed long-term rental income stream derived from successful franchisees. This income stream is highly stable because the demand for the underlying food product is relatively inelastic. The corporation consistently reports that the appreciation of its land holdings significantly outpaces the depreciation of the buildings, solidifying its status as a dominant asset holder. The real estate strategy fundamentally shapes the culinary culture by enforcing standardization. Standardization of kitchen layouts, equipment specifications, and operational flow is mandated through the lease to maximize efficiency and ensure product uniformity worldwide. This consistency minimizes operational complexity for the franchisee, allowing them to focus solely on high-volume execution. The physical location itself becomes a cultural anchor, leveraging high visibility and accessibility, which are prerequisites for the high sales volumes necessary to generate substantial percentage rent for the corporation. The consistency of the physical plant reinforces the global brand promise of predictable quality.
The real estate ownership model creates an insurmountable financial moat against competitors. Rival chains must invest heavily in both operational infrastructure and property acquisition, whereas McDonald's leverages its existing portfolio and franchisee capital for growth. This structure provides superior resilience during economic downturns, as rental income remains relatively stable, even if food margins tighten due to commodity price fluctuations. Ultimately, the corporation functions as a highly diversified, geographically dispersed real estate holding company, generating predictable, inflation-hedged returns, making it one of the most successful and unique business models in modern retail history.